What even are hedge funds, and how are they making billions? Let's break it down. Hedge funds are often seen as mysterious and elite. They operate in the shadows of the financial world, manage trillions of dollars, and influence markets globally. But what exactly are they? At their core, hedge funds are investment vehicles that pool money from wealthy individuals, institutions, or pension funds, and use a wide range of strategies to generate high returns. Unlike traditional mutual funds, hedge funds are less regulated, more aggressive, and typically only accessible to accredited investors. That means you usually need to be rich to even be allowed to invest in one. The term hedge comes from the original idea, hedging against market risk. But modern hedge funds don't just hedge. Many of them take on significant risk in the hope of outsized returns. That includes short selling, leverage, derivatives, currencies, and exotic strategies you've probably never heard of. So how do they actually make money? First, let's talk about fees. Hedge funds typically operate on a 2 and 20 model. That means they charge a 2% management fee on assets under management, plus 20% of any profits they generate. If a hedge fund manages $1 billion and makes a 10% return, it could collect $20 million in management fees and another $20 million in performance fees, just for 1 year. Multiply that by hundreds of funds and billions under management, and you can see how the numbers add up quickly. But let's go deeper into how they trade. There are many types of hedge funds, each with their own unique strategy. You have long-short equity funds. These buy stocks they think will go up and short those they think will go down. They try to make money on both sides of the market. There are macro hedge funds, which bet on global economic trends, currencies, interest rates, geopolitics. Think George Soros shorting the British pound in 1992. He made over $1 billion in a single day. Then there are quant funds like Renaissance Technologies, which use algorithms, massive data sets, and advanced math to make micro trades at massive scale. These guys operate more like tech companies than finance firms. Other strategies include event-driven, betting on mergers, bankruptcies, or restructurings. Distressed debt, buying bonds from failing companies at a discount. Multi-strategy, combining everything into one fund. But here's what really sets hedge funds apart. Leverage. Hedge funds often borrow money to amplify their bets. With $1 billion in capital, they might control $10 billion in assets. That can magnify gains, but also losses. This leverage is why hedge funds can make, or lose, huge sums in short periods. So why are they allowed to do all this? Because hedge funds are meant for sophisticated investors, regulators give them more freedom. But that freedom comes with risks. Many hedge funds have failed spectacularly, like long-term capital management in the 90s or Archegos Capital in 2021, which caused billions in losses across banks. Still, many hedge funds thrive. Firms like Citadel, Bridgewater, and Millennium have generated billions in profits, not just for themselves, but for their clients. Now, let's look at how they find an edge. Hedge funds spend millions on research. Some use satellite data to estimate Walmart foot traffic. Others analyze shipping data, social media trends, or even track executives' private jet movements. Anything that can give them an informational edge. They also have teams of analysts, economists, and data scientists. It's a blend of intuition, tech, and brute force analysis. And the best funds are constantly evolving. If a strategy gets too popular, it stops working. So hedge funds must constantly innovate. What about risk? Every hedge fund manages risk differently. Some use strict stop losses. Others hedge positions with options or counter trades. But not all funds are disciplined, and when they blow up, it can be messy. Investors lose money, banks take hits, and sometimes even markets wobble. Now, you might wonder, can retail investors benefit from hedge fund strategies? The truth is, yes and no. Most hedge funds don't publish their trades, but you can still learn from their general strategies. Many long-short equity approaches, for example, can be adapted using ETFs or options. And platforms like quant, Whale Wisdom, or even 13F filings can give you a peek into what the big players are doing. But always remember, hedge funds have more data, more capital, and more tools. Trying to replicate them one-on-one is nearly impossible. Instead, focus on understanding the principles, managing risk, thinking macro, looking for asymmetric bets. So to sum it up, hedge funds are high-powered investment vehicles for the ultra-wealthy and institutions. They use aggressive, complex, and often opaque strategies to generate returns, and charge high fees for doing it. Some make billions, others implode. But love them or hate them, hedge funds are a force in global finance. And now you know how they work. If you enjoyed this breakdown, subscribe for more finance explained simply, and check the links for affiliate brokers where you can start building your